Let's talk about some technical jargons. The idea is the same, but how they define it, let's see that. So they call them as synthetic options. Why word synthetic? So synthetic basically means that you are artificially doing something. You are artificially doing something, right? Let's take a very simple example. You want to buy a stock, NBCC, worth rupees 100. So you spent 100 rupees. Now, once you spend 100 rupees, how the payoff would look like? Make sense?
I think isn't your yeah, downside is minus 100, right?
Absolutely. No.
Yeah.
So yeah. So this is 100. So the price increases, your profits increases.
Yeah.
If the price goes down, your losses increases.
Right.
Till it becomes zero. Right?
Right.
So this is a standard way of buying a stock where you just went to your Zerodha or somewhere and you bought a stock worth rupees 100, and this is how your payoffs look like. So this is like a real transaction. Now what they say is, I want a similar payoff, but using option. In this time, in this whole transaction, you will end up spending 100 rupees.
Yeah.
Right? So they say, is there a better way? Is there a better way to achieve the same payoff, but by paying less? Right? How do you think we can do that?
So on the right side, you can you do a long call, and then on the left side you perhaps do a short put.
Short put, okay. So let's look at this. When we discussed initially, this is my long call.
Yeah.
This is my short call.
Yeah.
This is my long put.
Yeah.
And obviously this is
Right.
my long call, short call, long put. Now, if just take this along, okay, and shift it a little bit. Try visualizing that you are shifting this. Keep this intact. If you keep shifting this, like this, like this, so there will be a moment where it will somehow be looked like this. Yes. Which is as good as this is zero, and the what you get is here. Right? So you rightly mentioned this is long call and this is short put. A long call and a short put will give you a payoff which is exactly similar to your longer stock. But then in a long call, you paid the premium.
Yeah.
And in a short put, you actually receive the premium.
Yeah.
And obviously they will not be same depending upon what the price would be. But I can guarantee you it will not be equal to 100. Right? It will not be equal to 100. So effectively, let's say the net that you paid is 20. Instead of paying 100 rupees, you paid just 20 rupees and you got a similar, not similar, but exactly same payoff from both the two options.
Got it.
And then what they also say is that when you write a put option, in this case you are writing a put option, right? Right? Obviously, you're writing a put option with some exercise price. Everybody does that.
Yeah.
And let's say you put a you write an option which is put option for a strike price of 70, right? And then you put this 70 in the bank.
Okay.
Just to be secure that let's say you wanted to, let's say the person who is long the put is really going to execute the transaction. Assume a situation when the person who is long the put is going to execute a transaction. In that case, you will have to end up paying him 70 rupees. Is that correct?
Yeah.
Right. But then if you have secured your 70 somewhere,
Yeah.
mentally you are safe that no matter what would happen, the worst case scenario is I will have to pay 70. My 70 is secured, right?
Correct.
This transaction, when you do that, it is called as cash secured put. And the reason is very simple. Everybody wants to make money, and obviously he would have assumed that the price will not go down. But just saving enough money for the worst case scenario, right? And if you don't do that, it is called as naked.
Naked what? Sorry.
Naked put.
Naked put. Got it. Yeah.
Right? Make sense?
Yeah.
And the reason is very simple, because ultimately you are not hedging. Again, I was saying that you could have replicated the whole profit and loss scenarios, but then at the individual level, when you are long a call, you are safe. Worst case scenario, your option will go expire. That's the worst case scenario.
Yeah.
But in a short put, you have an obligation to redeem. Right? So if you don't do anything, you are naked put. But if you put enough money in the account just to be safe, it's called as cash secured put.
Got it.
Now, one thing that I kept on saying, that we paid, I kept on saying that I paid the premium and at ST something is happening.
Yeah.
But when it comes to finance, etc., when I say that you are really managing the money, then you would also have to think in real world terms that the money that you are paying is right now at time t equal to t. But whatever transaction would happen at t equal to st. So while keeping things simple, we just say that your profit payoff is 5 rupees minus the premium paid is 2 rupees, and then your profit is 3 rupees. But what we don't consider is that the amount that you paid as 2 rupees as premium has been paid at t equal to 0, while the amount that you get at t equal to t is 5 rupees. They are not same. The time has lapsed. Right? So effectively, there are two ways of doing things. Either you bring everything over here and then you subtract or add whatever, or maybe you take everything over here. The idea is simple, that you have to take care of time value of money.
Got it.
And I hope that a put call parity clearly tells that. You must have covered this in CFA level 2.
Yeah. I basically either the call premium plus either the discounted value of the underlying equals the put premium, something like that. Yeah.
Okay. I'll make it simpler for you. The idea is very simple. When it comes to put call parity, it says that you buy a stock. Right? When you buy a stock, what's your risk?
That it goes down to the amount you bought it at.
Totally, right?
Yeah.
That's the only risk. If it goes up, you're happy. If it goes down, you have a risk. let's buy a put. So you're safe, right? So you are buying a stock and you are protecting your downside.
Yeah.
So effectively, if this cancels out,
Yeah.
you are as good as buying a long option,
Yeah.
right? Plus the premiums, etc., that you paid,
Yeah.
right? And then this will say that you paid the call premium, and then your earnings would be the strike price, but then taking back at a present level. So they say that a put call parity talks about protective put and a covered call. We'll talk about this in detail. What are protective put, what are covered calls, we'll talk about this next. But the idea is that these two equations equate, and you must have used the put call parity in calculating one of the three variables.
Right.
Again, the focus on CFA level 3 is not to calculate the put call parity or maybe at the variable, but just to tell you. Now, so basically, there is a dealer who has sold a 4-month forward contract, right? Forward contract to a person who would purchase 1,000 shares of a stock at 179.59. The current share price is 179.
Okay.
Right? Interest rate is 1%.
Okay.
And the call and the put is same as 16.34 per share. Right? So the idea here is that this person has sold 4 months contract.
Yeah, so the other person has the option to buy it, but if he exercises it, no, he has to, right? He has to buy it in the forward.
Yeah.
Yeah.
So
then
effectively he can default, because in forward they can default, in futures they cannot. It's a mark to market. But assume that he will not. The
default.
idea is not to tell you that he will default. So the idea is that he will buy.
So he needs to have the underlying.
Correct.
Yeah.
So the dealer, he has sold, which means he will have to give it to the buyer after 4 months. Right? So basically this is the dealer and this is the purchase.
Yeah. Yeah.
Now, since the dealer has sold some contract, how will he hedge? Obviously, he will have to hedge the position.
Correct.
Now, when he has sold, what is the risk that if the price goes down?
Right.
So let's just talk about what if the price goes to 160.
Yeah, 19.59 he's lost. No, sorry. He's gained 19.59, right? No, not sure.
Okay. So think about this. When I've sold the contract, I'm looking from perspective of a dealer. I'm a dealer.
Yeah.
When I've sold the contract at this, effectively,
and you bought it at 160.
No, that would be at a maturity that I don't know yet.
Okay.
From a timeline perspective,
Yeah.
if it is a 4-month contract,
Yeah.
And this is T equal to 0. And this is T equal to 4 months. When I have sold the contract on this day, to hedge my position, don't you think that I should be long on the contract on the same day itself? When I have sold a contract, which is a forward contract, I should long
It
a
should be
call,
long. Yeah.
right?
Correct.
I should long a call. By the way, do you know that in a forward and futures, the profit and loss, they don't get truncated because the
Meaning?
transaction will happen for sure.
Oh, okay.
So in a forward contract,
There'll be an exchange of the security.
yeah. So in a forward contract, it doesn't give you a right or an obligation to either execute or not to execute. You will have to execute. Right? Again, the basic difference, and you would know already, and you must have read this in CFA Level 1, that a basic difference is that my yeah my forward is OTC product,
Yeah.
while futures is a standardized product.
Yeah.
Which means in forward you can default, while in futures you cannot, because there is a concept of MTM, mark to market.
Okay.
But the idea here is that we are not really concerned about that. In forward you can default, so he will not come and execute the trade. The idea is that in a contract, I'm not comparing forward versus futures, I'm comparing for contracts versus options. So while the options give you a right to execute in terms of long, and an obligation to execute in terms of a short, in a forward contract, the payoffs are very similar to buying a stock. It's just that we are fixing the price upfront. That's about it.
Got it.
What we say is that if the current stock price is, let's say, 100 rupees,
Yeah.
and we fix a price for 105, so even if it is 95 or even if it is 125, you will have to execute, and the profit and loss will be defined accordingly.
Yeah.
But there's no way that you can get away with the contract.
Got it.
So now think about this. Now coming back to the original question, when I said that he has sold a forward contract, it clearly means that the trade would happen for sure. Now the only thing is that he will have to hedge his position.
Yeah.
And how can he hedge the position? How about that he will long the call at this price, right? And he will short a put at this price. Now the question is, why short a put? Longer call, we understand, right?
Yeah,
Why is it longer call?
Because basically he's effectively set the right to buy, like the option to buy it at 179.
So there's no option.
Yeah, he has to buy it.
No, he has to sell, not him. Again, think from a dealer perspective. You are a dealer.
Yeah.
Think of it, you are a dealer, and okay, let's keep it simple. Let's not make it 179, let's make it 200. You are a dealer and I'm a purchaser. So you will tell me, Ankur, let's have a deal that after 4 months, I'll sell you at 200.
Yeah. Okay.
What's your risk? Your risk is, what if the price goes to 50?
50. Yeah.
What if the price goes to 250?
No, so as a dealer, you want the price to be lower, right, at that day.
But we don't know, right?
Yeah. We don't know.
Want it to be lower. But what if the price goes to 250?
Yeah. Then you're screwed. Yeah.
So as a dealer, how much will be your loss?
Your loss will be, if it's at 250, it'll be 50.
So your loss is 50, right?
Yeah.
And it's my profit, because we promise that you will sell me at 200.
Yeah.
So I'll buy at 200 from you, and I straight away go to the market and sell at 250.
Yeah.
Earning 50 rupees.
Yeah.
Now think about yourself.
Yeah.
How will you hedge that?
As someone selling a forward?
How does it help? Look, what you're saying is
No.
let's
Am I the dealer or the
you're the
purchaser?
dealer. You're the dealer.
Okay. So 1 sec. So
Yeah. Think about this.
so 200 I have to deliver. So it goes to 250 and 50. Just 1 second. Yeah, I think like you were saying that you basically then are long the security, right? The way to
Long
hedge.
security. Okay. How does it help? So,
So,
Gaurav, let's talk about what's your risk. Obviously, we want to hedge our risk.
yes.
So I said you are obligated, and we have a contract. You are a dealer. Just remember, you're a dealer. I'm a purchaser. We will talk about both the sides.
Yeah. So your
Right?
risk is like unlimited, like your loss
Whose
can
risk
be
is
unlimited.
unlimited? Mine or yours?
The dealer.
You are a dealer.
Yeah.
So your risk is unlimited, right?
Yeah.
Why? Because if the price goes to 10,000,
Yeah.
I'll still, as a purchaser, I'll still buy you at 200.
Yeah.
And you will have to buy at the current market price and sell it to me at 200. Are we on the same page?
Yes. Same page. Yeah.
Okay, perfect. Now, if you're on the same page and you understand that you have a unlimited loss, you could have
Unlimited.
unlimited loss, right? How about you buying a long option?
Yeah. So unlimited loss usually typically happens in like short call, right? So you have to do the inverse of that.
Yeah, I'm just saying
No,
that,
long call. Understood. Long call. Yeah.
yeah, right? Because you just want to hedge your risk.
Yeah.
You
Correct.
want a situation, that if the price goes up,
Yeah.
if the price goes up, very similarly, the payoff of that option should go up,
Yeah.
so
Yeah.
that it offsets the loss that you want to make.
Yeah.
Make sense? So a long call is a good strategy at 200 in this case,
Mm.
because even if the price goes to 250, right? Your profit is 50 from the long call that you have just bought.
Yes.
While since I'm going to buy from you at 200,
Yeah.
so your loss would be 50 rupees loss.
Yeah.
Effectively, you don't have anything, and the maximum loss that you would have is of the
The
premium that
premium price. Yeah.
is upside covered.
Yeah.
Is upside covered. Okay. Let's talk about the downside.
Hmm.
What if the price goes 150? Hmm. What if the price goes
One
to 150?
150. Then you effectively you've made 50 from
You
the
made
forward.
50, you made 50, right? Why?
Yeah.
Because the contract says 200.
Yeah.
As a buyer, I will buy from you at 200 only,
Yeah.
right? So what you would do is you will go to the market. You'll go to the market
Yeah.
You will buy at 150 and you will sell it to me at 200.
Yeah. Yeah. Yeah.
50 rupees upfront.
Yeah.
Right?
Yeah.
But the point is, you have all to secure the transaction. You have already. Acha, you don't know if it is going to go on 150 or not. You don't know that.
You don't know if it is. Yeah, you don't know that. Correct.
What I'm saying is, you have already paid some premium
Yeah.
while hedging the upside. I'm talking about
Yeah.
you. Remember,
Yeah.
you are a
Yeah.
dealer.
Correct. Correct.
You have already paid some premium to hedge your upside.
Yeah.
How about that you sell some put?
Okay.
Now, how does this help? If you will sell a put, obviously you will earn some money.
Yes.
Now, let's talk about what happens. When you sell a put, you will receive the money.
Yes.
Now, in this case, if the price goes 150, right? When you sold a put to somebody, he will execute.
Yes.
The price goes to 150,
Yeah. He will execute. Yeah.
right? When he will execute, you will have a loss of 50 rupees.
Yeah.
But then this person to whom you sold the forward contract, even he is going to pay you 200 for this.
Yeah.
So 50
Yeah.
rupees can be given from there.
Yeah.
Ultimately, you are at no profit, no loss.
Yeah. What if I
And
do only? What if I hedge only through a long call?
but then you will end up paying some money, right? It
Yeah.
will
Yeah.
cost you something.
Got it.
And the question clearly says that the premiums of call and put are same.
Got it. Got it.
So effectively, by doing a long call plus a short put will secure your transaction. And since premiums are same, it's the amount that you paid is zero effectively, and you
Mhm.
hedge the whole transaction upside and downside.
Okay. Yeah.
Now, obviously, even if the price goes down, you're not going to make the money, obviously.
Mm.
But if the price goes up, you're not making a loss either,
Mm-hmm.
right? Putting it another way, putting it another way, you entering into a forward contract, instead of that, let just longer call and shorter put. The payoffs are
Mm.
again same.
Mm-hmm.
That's just another way to put it.
Yeah.
Right? But the idea is the idea is that when we read a question, especially in level 3, I sometimes sit back for 30 seconds and I think, okay, what exactly do I need to do?
Mm.
Instead of thinking that I'm gonna long call and short put, which is difficult for me to interpret immediately. If I would know my objective, I want to hedge my position, then
Mm.
I think, okay, does it translates to some terminology?
Mm. Mm.
Right? When I know that I want to hedge my position, I want to hedge my long position. If the price goes
Mm.
up, it's going to be loss for me. So I would think of a product that will help me hedge that position. Then it comes to my mind that okay, a long call is a good option to hedge that.
Mm-hmm.
Right? So all I'm trying to trying to make a point that the idea here is not to learn and to understand what combination would solve this question, but to really understand what is my requirement.
Yeah.